So, there's a new way to get into physical gold right on the Singapore exchange. It's called the LionGlobal Physical Gold Fund. But what's really going on inside this thing? We've dug into the official prospectus to give you a clear, investor-focused guide on how it all works, the good parts, and, most importantly, the crucial risks you absolutely need to know about. Let's dive in.
Okay, so you're thinking about gold. It's a classic, right? But let's be real. Going out and buying an actual gold bar, then figuring out where to store it safely, getting it insured, it's a huge headache. What if there was a way to skip all that hassle? Well, that's the exact problem this new fund is trying to solve.
And here it is, the LionGlobal Singapore Physical Gold Fund. Now, it's an ETF, which stands for Exchange Traded Fund. The easiest way to think about an ETF is this. It's a fund that owns actual physical gold, but you can buy and sell shares of it on the Singapore Exchange, just like you would with any normal stock. The whole idea is to make getting your hands on real gold incredibly simple.
But how does that actually work? How does your money turn into a piece of the shiny stuff sitting in a vault somewhere? Let's follow the trail and see what's happening behind the scenes.
The concept is actually pretty straightforward. The best analogy is to picture a giant, shared safe deposit box. This box is just filled with real gold bars, and when you invest in the fund, you're basically buying a tiny piece of that box and a claim on the gold that's inside it.
The whole process is really direct. It all starts with you, buying units of the fund just like a stock on the Singapore Exchange. The fund then takes that money and goes and buys real, physical gold bars. Those bars are then tucked away in a high-security vault right here in Singapore. From that moment on, the value of your investment is designed to move right along with the international price of gold.
So how does the fund figure out what all that gold is worth day to day? Well, it uses a very specific, globally recognized benchmark. It's called the LBMA Gold Price AM. This is the official price that gets set every morning in London, and it's pretty much the gold standard for the entire industry. Using this benchmark is absolutely crucial because it means all the fund's assets are valued accurately and transparently.
Okay, so now we get how it works. Let's look at the first side of the coin, the upside. What is the main argument for putting your money into a fund like this one?
The fund's core mission is spelled out very clearly in the prospectus. Its number one job, its only job really, is to track the performance of gold as closely as it possibly can, before you factor in fees. This isn't some complex trading strategy. It's what you'd call a pure play vehicle, designed for just one thing, giving you exposure to the price of gold.
So let's just quickly run through the key advantages here. First, you get direct exposure to the price of physical gold, but you get to skip the logistical nightmare of owning it yourself. It's as easy to buy and sell as any other stock on the SGX. And maybe most importantly, your investment is backed by actual physical gold bars that are professionally stored and insured in a secure vault in Singapore. It really just boils down to convenience and accessibility.
All right, but let's be real, no investment comes without risk. So it's time to flip that coin over and take a hard look at the other side. What are the potential downsides and the risks that you really need to be aware of?
I mean, the full prospectus is over 100 pages long, and let me tell you, that risk section is dense. But we've waded through all the fine print for you to pull out the most important things that every single potential investor needs to think about. So what are they?
Okay, first up is a really important distinction. The difference between allocated and unallocated gold. Allocated means there are specific, identifiable gold bars set aside just for the fund. You have a direct title to them. Unallocated, on the other hand, means the fund just has a general claim on a big pool of gold that a custodian is holding. So why does this matter so much? Well, with unallocated gold, you're basically an unsecured creditor. That's a much riskier spot to be in if that custodian ever runs into financial trouble.
Next up, you've got the market risks, which, just come with the territory when you're talking about gold. First, the price can be super volatile. Second, and this is a big one, don't forget that gold doesn't generate any income, no dividends, no interest payments. A really key point from the prospectus is that the fund has to sell tiny bits of its gold to pay for expenses, and it's going to do that no matter what the price of gold is at the time. And finally, there's something called tracking error, which just means the fund's performance might not perfectly mirror the gold price because of those fees and other costs. Then you have what are called custody and counterparty risks. So even though the gold is insured, there's always that tiny physical risk of loss or theft. The fund is also relying heavily on just one single custodian and gold provider. If they were to run into any issues, it could definitely impact the fund. And believe it or not, even that official price benchmark isn't completely foolproof. The prospectus itself points out there's a risk it could be discontinued or even manipulated.
And finally, there are risks that are specific to you, the investor. The fund's base currency is the US dollar. So if you're investing with Singapore dollars, what that means for you is your final return is going to be affected by how those two currencies move against each other. Also, while it trades on the exchange, there's no guarantee that there will always be tons of buyers and sellers, meaning you might not be able to sell your shares instantly at the exact price you want. And the prospectus is super clear about this. This is for investors who are okay with the ups and downs of gold prices.
All right, we have covered a lot. We've gone over how it works, the potential upside, and some pretty serious risks. So, what's the bottom line here? Let's weigh it all up.
When you get right down to it, it all boils down to this one simple trade-off. On one hand, the fund gives you incredibly convenient access to physical gold, an asset that's usually a real pain to own. But in exchange for that simplicity, you are accepting a very specific package of market, custody, and counterparty risks, all those things we just walked through.
And that leaves us with the final question, the one that only you can answer, based on your own goals and how much risk you're comfortable with. After weighing both sides of the coin, is the convenience this ETF offers worth all the risks that are detailed deep inside that fine print?
This content is intended to serve strictly and only as an informational, independent, objective summary of recent events and should in no way be interpreted, construed, or relied upon by any party as inside information or financial advice.